This week, I started with a piece about NextEra Energy and specifically their capex program. I'd shown that over the past 6 years, NextEra's capex has grown at a 20% compound annual growth rate, which is far in excess of what we typically see for capital intensive businesses like the ones that NextEra runs. The 20% capex growth means that their property, plant, equipment asset base is growing at 11% per year. And that's even higher than the electric utility industry as a whole, which I pulled some data from the USBEA, and it came in at about 7% growth rate over the 6 year period. So NextEra is investing incredibly aggressively in their business. They're embracing this notion of pivoting their power generation assets in a much lower carbon direction, both on their competitive generation side and on Florida Power Light utility side. It's a very interesting story. There's frankly just an enormous bet that's being placed over there, and it's fascinating to watch. My next post was about Valero in their renewable diesel business. Renewable diesel contributes about 4% of Valero's total revenue and about 11% of Valero's total profit. So it's still quite small and is dwarfed by Valero's refining business. What we have seen, though, is the renewable diesel business has continued to grow over time continuously. And profit margins have started to settle in the past 2 to 3 years. Gross margins have settled in right around 20% in this growing renewable diesel business. And that's important to note when you compare to refining gross margins, which are around 15%. So the renewable diesel business is margin accretive to this point. It's growing very quickly. And of course, there are some PR and sustainability benefits to Valero having committed as many resources as it has in this direction. It's an interesting story. It's easy to underappreciate because, again, just the scale of the refining business and how that still dwarfs what we're seeing in renewable diesel. But renewable diesel is growing, it's growing rapidly. And Valero is very definitely one of the petroleum refiners that's investing most aggressively in that space. So that's also an interesting one to pay attention to. My third post was about the oilfield service companies. And specifically, we've heard a lot about how strong a growth avenue the international market is for these companies. What I showed was looked at year over year revenue changes across four different geographical segments. We looked at North America, Latin America, Middle East, Asia, Europe, Africa, CIS. And we see that the different oilfield service companies have different degrees of strength in these places. Halliburton is by far the most highly levered against North America. Halliburton has also seen the most growth in Latin America, which is pretty interesting. We see that SLB and Weatherford have grown the most in Middle East Asia, and Baker Hughes has seen some wins in Europe, Africa, CIS, outgrowing the others there. My point there is that when we paint with a broad brush, yes, almost all the growth that's happening around the world is happening outside of North America for these large oilfield services companies. But it's not all happening in the same places and not all to the same degrees for these companies. There really are important geographical differences that we're seeing when you start to peel back beyond just grouping that all internationally. That's going to be important to understand, knowing how important the international space is for continued growth in oilfield services. And not all of these markets will continue to generate and sustain the same momentum they have to this point. So it's a story on the oilfield services side that's absolutely worth paying attention to. I closed this week with a more funny, goofy note about Shell reporting its results on Thursday and announcing a $3.5 billion share buyback program. And then Apple announced results at the end of the day after the market closed and announced a $110 billion share buyback program. So I was sort of goofing off about how Shell's announcement seemed highly consequential right until Apple comes out and announces they're giving 30x as many dollars back to shareholders as Shell was. But there was some seriousness in the post, which is, well, Apple's absolutely larger than Shell. It generated $26 billion of cash from operations in the past 3 months. And that's only about $10 billion more, $13 billion more than what Shell has. So yes, it's it's closer to a factor of twice the cash generation ability that Shell has, but it's not 10x or 100x what Shell's doing. Yes, they're in very different businesses, but they're both massive multinational companies that live at the epicenter of incredibly important sectors for the global economy. And yet we're seeing that Apple just has an enormous war chest. So while oil and gas companies are absolutely doing the best they can to get cash back in the hands of shareholders, it's frankly nothing like what some of these large tech companies can do, given the war chests that they have access to. Each weekend, I send out a free newsletter that I call the Business of Energy. It includes links to and summaries of all the posts that I've shared online during the week. I also include an energy related anecdote, insight, or observation that I don't share anywhere else. So that way, if you've seen all the stuff that I've published online, you'll still have something new to read in the newsletter. We're getting right up to 1,000 subscribers there, which is pretty exciting. So there's a big community of us that are engaging in that way. If you haven't signed up, feel free to hit the link in my bio. I'll probably put a link below this as well. As always, thanks so much for reading, watching, liking, commenting, just participating in general. I really appreciate it. I hope you had a fantastic week, and we will talk soon.